real world rule of money today is going over vesting or being vested. And so a lot of the time it's funny how often words are just kind of thrown out there in the world of finance, and sometimes it's very well understood and sometimes it isn't. And so what we're talking about when someone becomes vested, or you hear a vesting schedule, is in a company-sponsored retirement plan, there are two participants that are adding money to the account. And so this circle represents the account. The dollars in it come from you or the employee and then come from the company match. And a lot of the time we get our 401k statement or Roth 401k statement or whatever plan the employer is doing, and we see the statement, and the statement says we have $35,000 in it. And so our brain just kind of immediately assumes that I have $35,000. But depending on how long you've worked there, depending on the company's vesting schedule, is what you walk away money would actually have. So for example, our account, when we're not 100% vested meaning owning, where we own a certain, where we own the whole thing, where it's not all in one place. All the money doesn't go into the same place. It might be in the same funds, etc., but how they keep track of it actually looks something like this. It's not all together where it's just all our money, we put in our money, they match the money, and we just can walk away with it. It's actually, for accounting purposes, and some statements have actually started to show this, where they keep them separate, where it says here's what you've contributed, and here's what the company has matched, and here's what the balance of the matched contributions are versus the contributions that you've made. And so to become vested with a company means that it goes back and it looks like this, to where if you walked away, you could walk away with all the money. Where how most companies work, what we've seen, is a schedule something like this, where year one, you're 20% vested. So what does that mean? So what that means is on the U side of this diagram, you always own or are 100% vested with the money that you put in, because there's no strings attached, no contingencies, no anything. You put the money in, it's your money, minus what the government's going to take, obviously, if you pulled it out. But that money is owned by you as long as it stays in the right plan. Then that's 100% yours. But then on the company side, if you only are there for 1 year contributing to the plan, you're only 20% vested, meaning if you walked away after the first year, you'd get 100% of your side and 20% of what the company matched. But then the question is, well, where does the other 80% go? Well, it goes back to the company. What about year two? In year two, you're 40% vested. If you walked away after year two, you get 100% of your side, 40% of what the company matched. Year three, 60%. Year four, 80% of the company side. Year five, 100% of what the company matched. And then you'd be in a scenario like this. So that's what vesting means, or having a vesting schedule. This would be a vesting schedule down here on the bottom right corner. And being fully vested in this scenario would be after year five. And so the benefit of both parties here is on the employee side, or in our diagram U, your benefit is as you put money in, you get a match. And so people say, well, that's an immediate 100% return on my money. No, that's a matching contribution. It's not a return. You're not getting 100% in your investment. You're getting a matching contribution. Because the employers can change what they're contributing. We match 50% on 3% up to whatever. And so that can change, but it's a matched contribution. And so that is money that is contributed to the plan that later will grow, turn into a larger sum of money, so that in the future when we go to pull money out, we have a little bit more. We have loyalty to the company for doing that, for matching these contributions. It's something that a lot of employers call the golden handcuffs, is how good this matching program is to keep people there, and that's what that vesting schedule does, is it keeps people there for longer. And then another benefit to you is that later when this grows down the road into a lump sum, is that when we pull money out, it wasn't just our own money that we are having to rely on, because when we pull this money out in a matching program, which most people have a 401k, those withdrawals are going to be taxed, and so that company matches there, so that as we pull money out and we get taxed on it, it's a little bit more. The other benefit to you is that the contributions that you make are a tax deduction to you. So if I contribute $10,000 to a 401k, then I get to deduct $10,000 from my taxable income. Similarly, on the company side, the company match, they get to deduct their matching contribution as well. And so that's the benefit to the company. One is it retains employees. Two, they're able to give back to employees, which creates a good culture. And then third is they get a tax deduction as they make matching contributions. Now, the only difference between you and the company is you put in money, you get a deduction today, and then it grows, and then later when you go to pull it out at retirement, you pay taxes on the money that you put in, where the company doesn't pay taxes on the money that they put in. They get the tax deduction to put it in, and then you or me or whoever owns the plan pays taxes on both what we put in and what the company matched. So that is how a vesting schedule, or being vested in a company, that's what it means, that's what it looks like, and that's how it works.